Great opportunities begin when the facts change before the price catches up. Every major chip company is fighting to win the AI race. Nvidia wants the fastest accelerator. TSMC wants the best manufacturing process. Samsung and Intel want to close the gap. ASML does not need to pick the winner, because before any of them can manufacture the most advanced chips at scale, they still have to go through the same company. And that company has just pulled forward a milestone investors once associated with 2030. ASML's new 2026 revenue guidance already reaches the bottom of the revenue range it laid out for 2030, 4 years early. Its planned 2027 low NA EUV capacity is already close to fully covered by orders, and demand is strong enough that management is preparing another major expansion. So yes, the stock is expensive, but at roughly $1,800, I'm still buying it. My base case is $2,100. My stronger bull case is $2,300. And the reason is simple. The valuation is high, but the earnings ceiling is moving higher too. Let's get into it. The easiest way to understand ASML is to stop thinking of it as a normal chip company. Nvidia designs chips. TSMC manufactures them. Micron, Samsung, and SK Hynix sell memory. They all compete with each other. ASML sits one step behind that competition. It makes the lithography machines chip makers use to print microscopic patterns onto silicon wafers. And at the leading edge, ASML is currently the only company capable of producing EUV lithography systems at commercial scale. Think of advanced chip production as a bridge. Every company wants to get to the other side, but there is only one serious bridge for EUV. ASML owns it. If the industry wants more advanced logic chips, more high bandwidth memory, and more AI computing capacity, more traffic has to cross that bridge. That is the moat. And right now, traffic is increasing. The latest quarter gave us 3 numbers that matter. Revenue was about 9.3 billion euros. Gross margin reached 54%, and new system sales increased from 67 machines in the first quarter to 86 in the second. You do not need to memorize all 3. Here is the takeaway. ASML sold more machines, produced better margins, and beat its own guidance at the same time. That is not just demand, that is demand turning into stronger economics. And there is another part of the business that matters almost as much as the machines themselves. ASML generated roughly 2.8 billion euros from servicing and upgrading systems that were already sitting inside customer factories. That makes the business more durable. ASML sells the machine once. Then it keeps getting paid to maintain it, improve it, and help the customer squeeze more output from it. Every new machine expands the future service opportunity. So the installed base keeps producing revenue long after the original sale. But honestly, the quarter itself is not the main reason I am buying. The guidance is. 3 months ago, ASML expected 2026 revenue between 36 and 40 billion euros. Now it expects 43 to 45 billion. At the midpoint, that is roughly a 16% increase. That is not a small adjustment. That is management telling investors the old earnings path was too low. And here is the number that changes the long-term story. At its 2024 Investor Day, ASML said it saw a 2030 revenue opportunity of roughly 44 to 60 billion euros. The midpoint of its new 2026 guidance is already 44 billion. So ASML has reached the bottom of that old 2030 range 4 years early. Now, that does not mean it has reached the top of the range, and it definitely does not mean growth will move in a straight line. But it does mean the old long-term model is starting to look outdated. Management plans to update its longer-term outlook at its next Capital Markets Day in June 2027. I think there is a real chance that new outlook moves the ceiling higher again. The next piece of evidence is capacity. Forecasts can change. Factory plans are harder to fake. ASML plans to increase its low NA EUV capacity by around 30% in 2027. It is also studying another 30% increase for 2028, and it is planning a similar expansion for immersion DUV systems. Why take on that kind of execution risk? Because customers are giving ASML much better visibility. The company says order momentum stayed extremely strong through the first half of 2026. Its backlog kept growing across a broad mix of customers. And for 2027, ASML says planned low NAE UV capacity is already close to fully covered by orders. It has also received a significant number of low NAE UV orders for 2028. Chip makers do not reserve machines like these for fun. They do it because they are planning real capacity for advanced logic, high bandwidth memory, and next-generation DRAM. This is where the bridge analogy becomes even more useful. More AI demand means more chip factories. More factories mean more ASML machines. More machines mean more service revenue later. And when the bridge is getting crowded, the owner has more power in price negotiations. Customers will still negotiate hard. TSMC is not going to accept every price increase with a smile. But when the machines are difficult to replace and future capacity is already filling up, ASML controls more of the conversation. Now let's talk about high-end AEUV because the name sounds much more complicated than the investment idea. Imagine trying to draw a detailed city map with a very fine pen. Current EUV is already an incredible pen. High NA replaces it with something closer to a precision engraving needle. It can print features about 1.7 times smaller and pack close to 3 times as many transistors into the same area. For chip makers, that can mean more computing power from the same piece of silicon. For ASML, it means a new generation of machines that can deliver more value and support a higher selling price. And this technology is no longer stuck in a research lab. Intel is now using high-end AUV on selected layers of its Intel 18A process to produce part of its Core Ultra Series 3 lineup. That is not full industry adoption, and customers still need to prove the economics at scale, but it is a real production milestone. High-NA is moving from a technical promise into an actual manufacturing tool. Now we get to the uncomfortable part, the valuation. At around $1,800, ASML is not cheap. The market already knows the company has a rare competitive position. This is not a hidden value story. The stock only works if earnings continue to rise fast enough to justify the premium. Here is my base case. I assume 2027 revenue reaches roughly 50 billion euros. I assume net margin lands around 31%. That would put earnings at roughly 40 euros per share. Using a premium mid-40s earnings multiple and then translating that valuation into dollars, I get a value around $2,100 for the US listed shares. That is my base case target. It is my estimate, not company guidance. My stronger bull case is $2,300. To get there, 3 things need to happen. The 2027 expansion stays on schedule, pricing improves without customers delaying orders, and high-NA adoption moves forward while current generation EUV demand remains strong. The valuation uses ASML's current share count and a euro-dollar rate around 1.14. From around $1,800, the base case offers upside in the mid-teens. The bull case offers upside in the high 20s. You are paying a premium for a company that controls one of the hardest to replace assets in global technology. That is why I would not buy the full position in one day. I would start with a partial position around current levels. If the stock pulls back into the low 1700s and the business outlook remains intact, I would add. If it runs sharply higher in a few sessions, I would not chase it. A great company can still become a bad purchase when the price moves too far ahead of the evidence. Now, there are real risks. China is expected to account for around 20% of ASML's 2026 revenue. Export controls already limit which advanced systems ASML can sell there. Tighter rules could hit both equipment sales and the service revenue attached to those machines. ASML owns the bridge, but TSMC, Samsung, Intel, and the memory companies still decide when to build. Execution matters too. A 30% capacity increase is difficult when every machine depends on an extremely specialized supply chain. And valuation is a risk by itself. When investors are already paying a premium, even a strong company can fall if guidance simply stops rising. So what would make me change my bullish view? First, customer commitments weaken and ASML delays the 2027 expansion. Second, margins stop improving even as the product mix becomes more advanced. Third, high NA adoption slows without enough current EUV demand to fill the gap. And fourth, export restrictions remove materially more China revenue than management currently expects. Those are the warning signs, not one bad week in the stock. And that brings me to the final point. ASML is expensive, but expensive is not the same as overvalued when the business keeps becoming more valuable. The company has reached the bottom of its old 2030 revenue range 4 years early. Its planned 2027 low-end AEUV capacity is close to fully covered by orders. Every new machine expands future service and upgrade revenue. And high NA gives ASML another way to sell customers a more valuable generation of equipment. That is why I believe the stock is still a buy around current levels. But it is a buy that should be built in stages. My base case is $2,100. My bull case is $2,300. Every major chip company is fighting to win the AI race. ASML does not need to know which one wins. It gets paid by the companies trying. So here is the real debate. Can ASML keep raising the toll without slowing customer demand? Or is the stock already priced for a perfect AI cycle? Tell me which side you are on in the comments. If you enjoyed this one, make sure to subscribe so you don't miss out on the next drop. And definitely save this video so you can come back to it.